District. And joining me now in studio with more is Kevin Mahn. He's the president at Hennion and Walsh. Kevin, great to have you.
Great to be here, Kristen.
Yeah, so let's talk about what this second half has in store.
Yeah, so it's the first day of the third quarter of 2025, and let's assess where we are. We didn't start off that great this year, right? Through the first 73 trading days of 2025, the stock market was down by 10.2%. The fifth worst start on record. However, those four previous worst starts, the market moved higher by an average of 23% from day 74 to the end of the year. Where are we this year? Well, from day 74 to now, we're roughly up 17%. So the question for me becomes, how much longer can this rally last? And will those short-term bouts of volatility come back? I think they're going to come back during the month of July.
Okay, so that is this month, right? And,
yes, it is.
And it's already starting pretty hot, at least here in the weather. We'll see how hot it gets in the market, Kevin. But what are the factors that could contribute to the volatility that you anticipate on the horizon?
Sure. Of course, first and foremost, the One Big Beautiful Bill Act. I anticipate that we'll get an extension of those tax cuts. If we don't, it will amount to the single largest tax increase in our country's history. However, there's a lot of debate over those other tax provisions. That could lead to delays. We move past that July 4th deadline. That could create volatility. The Fed meets in July. If, in fact, they hold pat on rates again, I think that's a negative to the market based upon their own forecast for the economy and for unemployment. And then lastly, the extension of those reciprocal tariffs. That comes due next week as well. If, in fact, there's no major trade agreements announced, if they don't extend that further, that will create more volatility.
It'll be interesting to see how the Fed does respond, right? We've heard from Jerome Powell multiple times now. It is a wait-and-see approach. He is anticipating tariffs could have some sort of impact. And, of course, with that deadline next week when it comes to trade policy, perhaps that will inform the Fed's decision that we see toward the end of July. So. The stock market at a record high, but we do see it. Does it still seem to be a headline-driven market at this stage?
It does, and I think the wait-and-see approach of the Federal Reserve runs the risk of the Fed being late to the party once again. What we learned after their June meeting is that they increased their forecast for unemployment to end the year at 4.5%. They lowered their forecast for economic growth to just 1.4%. In fact, they think it's going to stay below 2% for the next 2 years, and then they raised their forecast for inflation based upon their preferred inflation gauge, core PCE, to 3.1%. Add that up, that's the recipe for stagflation. But I think they're more concerned with the economic slowdown in the labor market than they are with the uncertainty of the inflationary effect of tariffs. So I anticipate, perhaps I'm wrong, a rate cut in July. If we don't get that, we got to wait till September because they don't meet in August.
Okay, so let's talk about where you see some of the outperformance in this market and what might look attractive as we still are near record highs.
Yeah, I always say follow the money. And where is the money going to right now? Aerospace and defense. We saw NATO countries commit to spend 5% of their respective GDP on defense spending. We learned from President Trump that he's looking to increase defense spending in the U.S. to over $1 trillion in the current budget. So who's likely to benefit from all that defense spending? Look to the major defense contractors. How about the ones that were recently used in the U.S.'s strike against Iran's nuclear operations? I start with the maker of the F-2 stealth Spirit bombers. Who was that? Northrop Grumman. How about those massive bunker-busting bomb? Who makes those? Boeing. Boeing, the same Boeing that was just awarded the new contract for the new next-generation F-47 fighter jet. But it didn't stop there, Kristen. We also had submarines that were used, who were made by who? General Dynamics. Firing Tomahawk missiles, who were made by who? Raytheon, a segment of RTX. That's where I see tremendous opportunities right now, but don't also ignore utilities. Utilities are a very safe play. They hold it well in the face of volatility, and they become a backdoor play into the AI revolution.
Okay, great to know, Kevin. Of course, before we know it, too, mid-July earnings season is going to kick off. Anything on your radar that we should be thinking about heading into corporate results?
Well, if you look at the forecast for earnings growth for the quarter, it's actually much lower than the previous 2 quarters. That's not a good sign because right now we have the stock market trading at pretty rich valuations. The only way to bring those valuations down is either for prices to go down, no one likes that, or for earnings to go up, and we're not seeing that. So expect the market to stay relatively rich right now. I'm going to look for indications from these CEOs in their earnings reports around their outlook for trade, for tariffs, and also for the consumer. All of that's very important for the U.S. economy because 70% of our economic growth comes from consumer spending.
That's right. Okay, so what I'm taking away, Kevin, is short-term volatility, but long-term gains once we get toward the end of the year.
Very well said.
All right, Kevin Mahn joining us here in studio on July 1st. He's a president at Hennion and Walsh. Kevin, always a pleasure. Thank you.
Thank you, Kristen.